In today's video, we're going to discuss risk financing. This is from CPCU 500 assignment or chapter 4. We'll begin with a look at risk financing goals. Then we'll look at the two broad methods of risk financing, retention and transfer. Then we'll discuss how to select appropriate risk financing measures. And lastly, we'll take a look at specific risk financing measures. So let's start with risk financing goals. Goals of risk financing include paying for individual losses, managing the cost of risk, managing cash flow variability, maintaining an appropriate level of liquidity, and complying with legal requirements. Let's start with paying for individual losses. Perhaps the most important of all risk financing goals is to not disrupt normal activities. Obviously, this is important because when a business is unable to operate, they're unable to make money. But in addition to the direct loss of business income, reputation can be a major factor. A disruption in normal activities can cause you to lose business. Take a retail operation. Really any retail operation, but let's say one that specializes in some area, such as bike repair. If I normally go to a certain business for bike repair because of tornado damage or a fire or even a large theft, I might find a different business, and once I've chosen a different business, I might not go back. Additionally, it's generally a good idea to pay liability claims quickly. And if a business doesn't have insurance, and they're trying to pay liability claims out of cash flows, they may not be able to pay those claims quickly. This relates to public relations issues. Think about a business that has an injury on their premises and they don't pay that claim very quickly. This might hurt their reputation. They might lose customers because of this. When paying for individual losses and thinking about the cost of those losses, the cost of loss includes the loss cost that's in the insurance premium. Let me break this down. An insurance premium includes an amount to cover the loss, which is the loss cost. In other words, the amount the insurance company pays to cover the loss, and loss adjustment costs. That's what they pay the claims adjuster, a lawyer, an investigator. All of that factors into loss adjustment costs. And an amount to cover other expenses, including brokers or agents' commissions, underwriting, taxes, and overhead, and other things like marketing and other administrative expenses. The amount to cover expenses and the loss adjustment cost both exist because of the insurance presence. These are insurance-specific costs that do become a part of the business's cost, but they're not specifically loss costs. The reason we point this out is because when considering risk retention versus risk transfer as risk financing mechanisms, you have to consider that insurance-specific costs are over and above the loss cost. We'll continue to talk about that throughout this video lecture. A second goal is to manage the cost of risk. Consider that there are administrative expenses, especially if you retain the cost of financing a risk. There's the cost of internal administration, paying someone to help pay the claims, and the cost of any external services you might need. Again, external claims handling and risk management consulting, maybe hiring a lawyer or a cybersecurity specialist or an accountant. And of course, a business has risk control expenses, as we just discussed in the last lecture. These are, of course, the cost to reduce the frequency and severity of loss, and the cost to increase predictability of future losses and cash flows. And then the cost of risk financing. Those are the cost of paying for losses and the transactions costs. It's those costs that I just mentioned, the commissions, the overhead, and the loss adjustment expenses and other similar costs that are all considered transactions costs and are over and above the cost of losses. The market often dictates transactions costs. For example, when there's a hard insurance market, that means that costs are high because the availability of insurance is lower. In a soft market, the market is much more competitive and transactions costs tend to be lower. The next goal is managing cash flow variability. You must know the individual or organization's willingness to accept risk. For an individual and sometimes a small business, This often depends on family obligations. Many of you have even told me that some of your businesses have a greater level of ability to manage cash flow variability than others. If a business employs all of its family members, or if it's totally dependent on the business income, they're unable to assume as much cash flow variability than a business who has other sources of income or doesn't have too many individuals in their family dependent on the business. But for any organization, the size, financial strength, and risk tolerance in general for that organization affects their willingness to assume variability in cash flows. And you must also consider other stakeholders, owners, customers, and even the community's risk tolerance. Another goal is to maintain an appropriate level of liquidity. A quote from the CPCU text: "As an organization's retention level increases, so does the level of liquidity required." Liquidity can be increased by selling assets, borrowing, or issuing debt or stock. Remember that liquidity means the ability to convert any of these things into cash without a significant loss in the value of those items. So you must consider the cost of borrowing, which is basically interest, and you must consider the loss in value when selling real property or a longer-term asset. And an organization must comply with legal requirements. If an organization has a commercial auto exposure, they must purchase commercial auto liability. And if they have employees, they must purchase workers' comp. Additionally, many times contractual obligations, liability for contractors, and property insurance for borrowers are required under the contracts because of the relationship between the business and other businesses that it works with. Now let's talk about retention versus transfer. The reality is that most risk financing methods are a combination of both retention and transfer. When you look at a spectrum, with retention being on the left and transfer being on the right, insurance actually falls in between. Mostly insurance is the transfer of the cost of loss to an insurance company, but some amount of loss is always retained even with insurance. This is primarily because of things like limits and deductibles and other cost-sharing elements of an insurance contract. Let's compare the characteristics of retention to the characteristics of transfer. Retention can be the most economical, but it results in the most cash flow variability or unpredictability. Examples of funding measures for retaining risk are current expensing, just basically paying for losses out of cash flows, having an unfunded reserve, which is a liability that is simply an accounting entry, or a funded reserve, which is actually setting aside liquid assets to pay for losses. So while these assets may be earning a small interest rate, they're fairly liquid so that in the event of a loss, they can easily be accessed. And then borrowing to pay for loss, which of course includes an interest cost and a potential depletion of resources. Advantages of retention include a cost savings, which is avoiding those transactions costs I discussed, and reducing moral hazard and adverse selection and other costs that we discussed in Risk Management 2005. Also, an organization controls the claims process when they retain risk. Think about a liability situation. Because the insurance company actually is obligated to defend the insured in a liability, they make the decision about whether or not to pay a liability claim. If a business self-insures liability, they make the decision about whether to fight or pay a claim. Additionally, a business retains investment earnings when they retain. Think about the funded reserve. When they set aside liquid assets, they're still earning a certain amount of interest. So until the loss occurs, they're able to keep those funds in interest-bearing assets. And retention generally results in the greatest loss control incentive. When you're the one paying for losses, you have a greater incentive to prevent and reduce losses than if someone else is paying. Now let's talk about risk transfer. Keep in mind that risk transfer does not eliminate the responsibility to pay for a loss. So this basically means that it's not a perfect transfer. If for some reason the insurance policy won't pay for a liability because of the terms of the contract, the business is still responsible to pay for that liability. Also remember that transfer should always be more expensive, ceteris paribus, and this is because of the transactions costs we've been talking about. Advantages of transfer, though, First, reducing exposure to large loss and reducing cash flow variability. Again, this goes back to insurance being an exchange of a small certain sum, the premium, for a large uncertain sum, the large uncertain loss. Also, insurance companies and brokers provide ancillary services. Take a look at Aon's website and you'll see several risk management services such as political risk consulting and workplace safety training that insurance brokers now provide. And look at Chubb's website. This in particular was interesting. I'd like you to watch this video on cybersecurity, which talks about the fact that many companies today don't realize how much risk they face because of their cyber exposures. And finally, transfer avoids adverse public relations, especially in the areas of workers' comp and liability. This is because the business can turn over the payment for liability or workers' compensation to the insurance company, and generally speaking, this will result in quicker and more effective payments. Now let's turn to selecting appropriate risk financing measures. Let's look at the major factors influencing the ability of using risk financing to meet organizational goals. We'll talk about the mix of retention and transfer, loss exposure characteristics, and individual or organization-specific characteristics. These are all three things that an organization needs to consider in making certain that risk financing measures do help the organization meet their goals. Let's start with the mix of retention and transfer. An organization should consider size and predictability of potential losses and liquidity of funds and associated cost. In general, the larger the losses, the less likely you are to retain and the more likely to transfer. The more predictable the losses, the more likely you are to retain and the less likely to transfer. But also, you need to consider the liquidity of funds and the associated cost of having liquid funds. For example, it might be better to have funds tied up in income-generating projects and pay a small insurance premium than to have money set aside that is liquid and able to pay for losses. Other risk tolerance factors must also be considered. As we discussed, a small business may be entirely dependent on the business for its income. It may not be able to handle wide variations in income. And additionally, as an individual business owner, your own feeling about the community, your environment, and your responsibilities play a greater role in how you treat the business and how you treat risk than it would for a large organization whose overall goal is just maximization of shareholder wealth. Now let's talk about loss exposure characteristics. This was the focus in principles of risk and insurance. We looked at frequency and severity in determining how to treat risk. Remember the 4 quadrants of risk, which was a simplification of the Prouty method that we recently spoke about as well. This is similar to what you see in the textbook, but it's also the table that I presented in ARMIN 205. You see that there are 4 quadrants of risk: the low frequency, low severity, high frequency, low severity, low frequency, high severity, and high frequency, high severity. And for risks that are low frequency, low severity, the best method is to retain them. For high frequency, low severity risks, the best method is to control and retain them. This is because any risks that are low severity don't have a great impact on the organization and probably don't make sense to transfer, especially when they're high frequency, because high frequency risks are often predictable and there's no benefit to transferring them to the insurance company to improve the predictability of the group over the individual. Next, we look at the low frequency, high severity. These are the types of risks that should be transferred. This is because while they're low frequency and generally not predictable, they don't happen very often. You get a big benefit to transferring these types of risks. And it's important that you don't retain them because they are high severity and therefore can have a great impact on the organization. The high frequency, high severity risks are a little more difficult. In general, you should avoid high frequency, high severity risks. And also, as with every quadrant here, try to control those risks and reduce and minimize losses and try to move those risks into a lower frequency or lower severity quadrant. But that's not always possible. As we've talked about, contractors and mining operations, and in some cases, medical operations such as obstetrics and orthopedics. The risk is very high and frequent, and it cannot be avoided because it's just part of doing business. If possible, you should transfer those risks also. And in some cases, you may not have a choice, especially when it's mandatory that you purchase insurance, such as workers' compensation. Additionally, when it comes to loss exposures, you should consider the predictability, which is related to frequency. As I said before, the more predictable the risk, the less likely you are to transfer and the more likely you are to retain. This is because if you know that losses are going to occur, if they occur with regular frequency every year, then it's probably more cost effective to set aside funds to pay for those losses than to transfer them to the insurance company and to have to pay the transactions costs that are associated with buying insurance. Also, you should consider whether the risks are critical, important, or unimportant. Remember that critical risks are those that if the loss occurs, it might cause the business to shut down operations either temporarily or permanently. Those risks must be paid particular attention to, and most likely those should be transferred and controlled, but should not be retained. Now let's discuss individual or organization-specific characteristics. This might just be an individual's own risk tolerance. Some people are just more risk aggressive than others, and some people are in businesses where they can withstand more volatility than others. But you also need to consider the financial condition of the business. For example, a poor credit score would mean that it would be more difficult to borrow, and you might have to borrow at a higher interest rate. So retention is less attractive. Also, you should consider the core operations of the business. In general, what we mean here is that it's easier for a business to retain risks that are related to its core operations than those that are tangential to their operations. Because generally speaking, a business knows more about its own operations than anything else. So it's easier for them to predict loss and to retain. But this can go both ways, because at the same time, you want to make sure that you protect your business against critical risks. So you might decide that you want to protect core operations by engaging in both risk control and risk transfer. Additionally, you want to consider the ability to diversify, which is often related to the size of the business. In general, the more able a business is to diversify, the more likely they are to be able to retain risk. So for example, if you're in a business of making pipes, and for some reason the equipment that you use to make pipes is not available or destroyed or damaged, but you can easily diversify and make other items, then you're more likely to not need to transfer the risk of making the pipes. Also, the ability to control losses. The more able a business is to control losses and to manage the predictability of those losses, the more likely they are to retain risks rather than transfer them. And last, the ability to administer a retention plan. Consider the possibility that you decide to retain your workers' compensation risk. Now, in general, you have to be of a certain size and have a certain amount of capital to even do this. Let's assume that you have met those requirements. Are you going to be able to administer the plan by paying worker injury claims as they occur, both the medical and the lost wages, and in some cases the rehabilitation? This might mean the business taking on more than they actually planned for. Now let's discuss specific risk financing measures. We'll start with guaranteed cost insurance, and then we'll discuss variations of self-insurance, and related to that, alternative risk transfer. Guaranteed cost insurance is what most of us think of when we think of insurance. The premiums are specified in advance, and it's the exchange of a small certain amount for a large uncertain amount. So this is the type of insurance you hear me talk about all the time. And this is the most common type of insurance and the most common way of transferring risk. Large organizations often need multiple insurers to supply guaranteed cost insurance to cover their loss exposures. This is known as a multi-layered liability insurance program, and the one in the book actually includes a buffer layer. So the way this works is all of this particular organization's liability is covered by this one program. The auto liability coverage, though, is less than the amount required by the umbrella policy that sits over this level of coverage. It might help to put numbers here. So this might be $2 million in limit, and the umbrella might actually provide an additional $5 million, which would actually make the attachment point here $7 million. This might be another $2 million, making the attachment point $9 million, another $2 million, and so forth, making this attachment point $11 million, and this one $13 million. And there are different policies for each one of these layers. The buffer layer is required by the umbrella policy because it requires that there's $2 million of protection or coverage under the umbrella policy. But say you purchase your liability from AIG, and AIG is only willing to provide $1 million of coverage on the auto liability layer. The insured would have to get a different coverage for this $1 million of exposure between the umbrella and the auto liability primary layer. Don't worry about this too much. We're not spending a lot of time on this in this class, but we do spend more time on this in property and liability insurance and in surplus lines and reinsurance. Just note that each one of these points are known as attachment points. And the way that this basically works is that when a loss occurs, let's say that it's an employer's liability loss, and let's say that it's a $8 million loss. The insurer on the primary layer, AIG, would cover the first $2 million of loss. The next layer, which I said was $5 million, would be covered by the umbrella policy insurer. And then the excess over that, which would actually be $1 million, because you have $2 million here with AIG, $5 million with the umbrella layer, and then you have another $1 million. That's the excess layer. All of that equals $8 million. And that's generally how excess insurance and umbrella policies work. So now let's talk about variations of self-insurance. Self-insurance is basically a form of insurance in which an organization has a formal system for recording losses and paying for them. It's usually combined with excess insurance, as we looked at before. So the way this would work is that an insured would actually self-insure a certain amount of retention, and that's what this quote layer is called. This could be, for example, $3 million. And then they would purchase excess coverage, similar to what we just saw in the previous example, over that particular layer. The excess insurer would not get involved in the claim unless the loss exceeded, in this case, $3 million. So, as soon as the loss is any amount over $3 million, the excess insurer would then get involved. This is well suited for losses that are paid out over a period of time, such as workers' comp and liability. This is because a company doesn't have to pay the entire loss all at once, so they can actually plan for the payments year after year. And the cash flows with these types of losses are basically known, so of course they're more predictable. Next, there's large deductible plans, which are very similar to self-insurance with excess coverage. The key difference between this and self-insurance is that the insurer pays or settles losses below the deductible and then seeks reimbursement below that attachment point. So, back to our example, if you have $3 million as your deductible, that's maybe a $7 million policy, the insurer actually gets involved in the claim right at the start. They'll pay the claim and then seek reimbursement for the $3 million deductible. This again is the attachment point. Last, under self-insurance, is the captive insurer. A captive insurer can be owned by multiple parents, but a pure captive only provides insurance for its parent. Generally speaking, a captive insurer can be defined as an insurer that only provides insurance for its parent or parents. It is a formalized retention plan, therefore. Typically, organizations will establish captive insurers instead of providing self-insurance for their own organization so that they have a tax advantage. There are also special types of captives, such as risk retention groups, These were established in 1986 under favorable tax laws that ensure parent organizations for liability only, and rent-a-captives, where the members of the rent-a-captive pay premiums for their own losses. Then a protected cell company, which is very similar to a rent-a-captive, but it has additional protection over a rent-a-captive from other insureds under the captive's insolvencies. Now let's discuss alternative risk transfer. But before I do, let me mention that even self-insurance plans are often identified as alternative risk transfer, or ART. First, finite risk insurance plans. These are typically only used for very hazardous loss exposures. They're actually more of a risk sharing between the insured and the insurance company rather than insurance. The premium is usually a high percentage of the total exposure, as much as 80%. And then the insured shares in the investment income of the premium. This allows an insured to certify insurance that might not be available to them in the guaranteed insurance market. For businesses like mining and logging and some types of hazmat transportation, because they're required to carry certain types of insurance like we discussed, liability, commercial auto, and workers' compensation, this might be the only way they can purchase insurance. Then there are also pools. A pool is a group of organizations that insures each other's loss exposures. It actually operates much like an insurer by collecting premiums, but it can sometimes result in lower premiums for the pool because of lower transactions cost for its members. Another way of thinking of a pool is that it's a group of businesses that join together to self-insure each other, and they achieve a certain economies of scale and greater predictability in loss by joining together, but they reduce the transactions cost of actually having to establish an insurance company. These are commonly effective for businesses that have something very much in common, like public entities or agricultural businesses. The benefit of having a pool often depends on the tax laws of the business's home state. Then there are retrospective rating plans. These are much like guaranteed cost insurance plans in terms of how they operate, but the big difference is that a deposit premium is paid, and then an additional premium is required at the end of a policy period if the loss experience exceeds expectations. So this protects the insurance company in the event that the premium collected is not enough. However, there are maximum and minimum premiums. Similar to finite risk insurance, these are often used when a business can't get insurance for a type of insurance that's mandatory, either because they are a high hazard business or because of a bad past loss experience. They're most common for workers' compensation and liability. And last, let's look briefly at non-insurance ARTs. First, hold harmless agreements. We've talked briefly about hold harmless agreements before, and we'll talk more about them in both the property insurance course and the liability insurance course. Another non-insurance method of transfer is in the area of capital market solutions. A common example is securitization in the form of a catastrophe bond. Investors buy the bond, and the bond earns interest, and at the end of a specific period, if there has been no catastrophe, the investor gets proceeds of the bond and interest back. But the bond investors get less of a return if the catastrophic loss specified in the contract occurs. So the catastrophe bond would be specifically for hurricane or specifically for earthquake, flood, etc. There's also hedging. This is common in commodities markets where you use futures or options, in other words, derivatives, to lock in a specific price for things like corn or hog, and options which lock in currency exchange rates and interest rates and stock prices. This is a method of managing speculative risks. And last, contingent capital arrangements. Contingent capital arrangements are basically like having a large credit line that activates when a loss occurs. And that's the end of our discussion of risk financing.